You are listening to KeyStone Stock Talk Show, episode 271. If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at KeyStocks and on Facebook. And keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold. It's great to chat with you again this week. I will start with a segment from our recent live webinars on whether or not you can gain meaningful exposure to potential 10x stocks through big bank small cap funds. In our Your Stock Our Take segment, Aaron addresses a viewer who is looking at some higher yielding stocks that have the potential to do well as interest rates fall. The viewer came across Doman Building Materials, symbol DBM on the TSX, which has a yield of 7% approximately, and asks if it is sustainable. Brennan answers a viewer question on Atlas Engineered Products, symbol AEP on the TSX Venture, a small cap and a management team that we'll be sitting down with to interview this coming week. Atlas is a consolidator that designs and manufactures trusses, floor panels, wall panels, and distributes engineered wood products. The company is profitable and has grown revenue significantly long-term, but faces tougher market conditions near-term, characterized by weaker housing starts and permits caused by elevated interest rates, conditions that are expected to persist through the balance of 2024. Brennan lets you know the current financial picture and what we're looking to ask management this week. Finally, Brett takes a viewer question on Simply Solvents Concentrate, symbol HASH or HASH on the TSX Venture, a microcap which develops and manufactures cannabis products, including pre-rolls, concentrates, distillates, among other products. The business bucks the trend in the segment by being profitable and has seen a significant increase since its share price since it IPO'd in December 2023. Can the gains continue, or will Simply Solvent be another cannabis stock to go up in smoke? Now let's get to the show. My co-host, Mr. Aaron Dunn, and the Killer Bees, Brett and Brennan. How are you guys doing?
Very good.
Well,
very good.
Doing good. Doing good.
You ready to interview about what is it, 15, 18 in that range management teams we've got coming this week at a couple conferences? Brennan, you're flying
have a
out to
conference coming
Vancouver.
up this week.
Yeah.
I know. Heard something about that.
It's true.
It's
true. It should be good. We'll sit down with, I think there's 5 or 6 companies we actually have in coverage, recommendations on currently in that range. But there's also some additional companies that we're looking to potentially put in coverage over the course of the next year. And hopefully we have fruitful discussions with some of the management teams there.
And this is this event coming up. This is
Planet Microcap.
Planet Micro in conjunction though with
small cap discovery.
Right?
Yeah.
Okay.
Correct. Yeah, I'm kind of sad that I'm leaving Saskatoon I fly out Tuesday, but Wednesday it's supposed to be almost plus 30 in Saskatoon, because I know it's right around the corner. It's about to be minus 40.
Were you going to be doing some sun tanning on those days on Wednesday?
I was
just
considering
basking out on the balcony.
I was considering it. I am looking a little bit pasty right now.
Golfing?
Maybe golfing, but I also have to
minus 40.
Yeah, it's coming quick probably.
Yeah, it's going to be a quick flip, eh?
Yeah, it always is.
All right.
Remember when we were all in Vegas and Brennan complained about the heat and I said he was soft, and then he started talking to me about minus 40 conditions.
Yeah.
In the city that he lives in.
I like the cold over the heat, but anyways.
Yeah, when I was there recently in Vegas, it got up to 45 degrees. I mean, that was fairly hot. Yeah. On average during the day. It was crazy.
I'd be crying. Yeah.
It's a dry heat though. Not like if it was 45 in Toronto, you'd literally just slit your throat. It's over. All right. So let's get to we can get to our poll question, right? We got nothing else to talk about here. Poll question, interest rates. We're talking about that, and Brett's going to go through the poll.
Yeah. So interest rates have been cut in both US and Canada.
And the question is, have you or do you expect to shift your fixed income, so bonds, GICs, treasuries, or bond ETFs, the likes of those, allocation in the near future? 55% of our audience says no change, 9% says they're actually going to increase their fixed income allocation, and 36% say decrease their fixed income allocation.
Sorry, 36% said decrease?
Decrease, yes.
Yeah, okay. And what said increase?
9%.
9%, okay. Interesting. Yeah, I mean, it's one of the companies that I'm going to talk about today is a high yield stock. So it kind of fits into the whole, are people going to be shifting out of fixed income into higher yielding companies? That a lot of these companies have kind of been ignored for the last couple of years as interest rates were higher. You can get better yields off of fixed income and GICs, but now those yields are coming down, make some of these high yield dividend stocks look more attractive.
Yeah,
we have already seen that shift happen, but the question is, will it continue?
Yeah.
And like we asked a similar question like this, like, I mean, when Canada started, moving the interest rates lower, and I mean, I think it was pretty similar results. Hey, Brett, what was it not?
It was a bit more towards staying the same.
Okay.
I think I just did decrease or change. But yeah, no, there's definitely a shift. And I'm not surprised, given it's been more in the news, especially with the US now cutting their jumbo, is what I've been seeing, or massive along those lines. It's only 50 basis points, which is compared to Canada when we were actually starting to raise. We actually raised by a full percentage point at the start of the raising cycle. So 50 basis point cut doesn't seem like a massive change, but that's what the headlines are saying.
And more than expected. I mean, it was more. General consensus, I think, was 25. So
I was following that relatively closely leading up to it. And a month ago, it was pretty firm in the 25 camp. So it was just slowly increasing. I think the day before it actually was something like a 65% the market was pricing in a 50 basis point. So it was raising over time. And I think Jerome Powell's Jackson Hole speech was really what set that off. I think prior to that, it was almost all on 25 points. And then it just slowly raised after that.
Yeah, I mean, I think there's a psychological level there too. If people see a GIC dropping, even their prime link GIC or something like that dropping below 4%, and then they can get a dividend yield of 4% plus, that dividend yield can grow. You start to see now, is it just better to shift back to dividend stocks? And you're seeing that in the market with the rise in some the companies that we follow. And Aaron's looking closely now to see if there's companies there that we really want to shift into. We're buying those good quality dividend stocks at any time. And is there going to be, a stampede into those? Maybe not a stampede, but you might see certainly markets can shift. And if they become on vogue in the near term, you typically see a rise in those companies. And we're already seeing that. Aaron's already been talking about that for the last month or two.
Yeah, you see that across all stocks, not just dividend payers. But I think the aspect of dividend yield just being so visible is because for like a growth stock, which pays no dividend, that high tech stock is just embedded in their discount rate of their cash flows, which will be why you always say lower interest rates means higher stock prices. But with dividend yield, it's much more apparent. You can compare more one-to-one, and that's much more front and center than just a discount rate.
Yeah. No, it's easier to understand for the average investor for sure. And that's what, psychologically probably they're looking at sometimes is just the rate difference. But yeah, I mean, all stocks should in theory be more attractive if rates lower. All right. Yeah, as they do. So in theory. Now, well, I mean, of course, we could get into
they should have been less attractive as interest rates were going up. And yet we saw rising valuations, more expensive valuations. So you just never, it's sometimes there's a lagging effect and
of course
pricing in expectations.
The other thing is you got to question, why are interest rates coming down? Like what is that generally an economic downturn? So then, if you hit a recession, then stocks aren't as attractive. So these things have to kind of balance out.
And since we brought it up when it was first happening, the yield curve, it's been either not inverted or hovering around not being inverted now. So if that goes, if we don't get a recession soon, it's the best indicator of recession will no longer be true. So It's one of those things where that's why at the time we're pointing out it only had like a dozen or so examples of that in the US of interest rate yield being, or interest curves being inverted. So that's why you can only put so much money on things like that.
Just another tool that doesn't.
I remember the interest rate, the yield curve, I believe, was it not inverted like around 2016, 2017 as well? Thought I remember, or maybe it was just getting close to inversion. I know
that it was like,
I'm pretty sure that it was.
I think like 2019, like it briefly inverted, and then people were like,
sorry, Brendan?
I think in 2019, like
it was 2019. Okay,
2019 it did, but then we got the pandemic, so it's the yield curve predicted the pandemic. Yeah,
because I remember people saying that it's like, oh, the yield curve predicted the pandemic. I remember literally reading headlines of that, and it's just like,
of course it did.
Did it really?
Yeah, exactly.
Oh, the yield curve. Okay, so I think we should go into the show. We got a busy week this week and a busy show. So one of the core areas of our research is profitable growing small cap stocks. We just completed a webinar on how and where to find 10x stocks, or essentially great long-term growth stocks. The data tells us that profitable microcap businesses are fertile ground for identifying potential 10x stocks. So one of the areas we explored in the webinar was how to gain meaningful exposure to profitable 10x micro and small cap stocks. And when I say this, I stress the word meaningful because we want to design a portfolio that is well positioned to actually benefit from holding a great capital compounding stock. In theory, if you hold an index ETF on the entire Canadian market, for example, you have exposure to every stock. So you are exposed to the next great small cap or 10x stock. But if it is 1/10 of 1% of your entire portfolio, even if it doubles, triples, or runs 10x, which is the best case scenario, one of the best case scenarios, it still has little impact on your overall returns. So one of the avenues we explored was by gaining exposure to these stocks was by investing in a bank-run small cap mutual fund. Why? Because in theory, owning a small cap fund to gain exposure to small cap stocks, that makes sense, does it not? And most big banks have a small cap fund, just like when you need something on the internet, you know, there is an app for that in the financial world. The big banks have created a fund for that. One thing they're great at doing, creating products that are saleable to investors. Now let's look at one of the big banks' flagship small caps funds to see how well you gain exposure to quality small cap stocks and potentially benefit from finding the next 10x stock here. But first, I'm just going to look at the definition of a big bank fund, or the definition of a small cap stock. Generally, market participants consider Canadian small caps to have a market cap of 800 million or less. To be included in a small cap fund, most stocks should hold market caps of under 1 billion. All right, let's look at that snapshot of that fund. Now, this is the TD Small Cap Equity Fund. Again, I'm not picking on TD today. All the big banks have a similar form of this fund. So if we look here, just based on the holdings alone, just the number of holdings, there's so many problems with this fund. It's far too many stocks. In the webinar we showed participants that you can have an optimally diversified portfolio with just 25 stocks. In fact, it's less than 25. This fund has 116 small cap stocks, or I'll quote that, small cap stocks. Far too many stocks to gain exposure to a segment. Far too many. It's unnecessary. I allude to this just a second ago. The real problem is that constructing a fund with this many stocks, even if one of the stocks happens to be a Boyd or a Hammond Power, these are small caps from our coverage that have gained 10,000 and over 20,000% respectively. Its impact on the fund is neutered, as it is one of 116 stocks in this small cap fund. So even if the stock performs incredibly well, we talked about this gaining 100%, that would likely add less than 1% to this fund. Of course, if you're going with a big bank advisor, that would be one of 10 plus funds that you may own. So the gain in your portfolio, if you owned a truly great 10x stock via this fund, would be likely less than 0.1%. If you're not gaining meaningful exposure to a 10x stock through this fund. The construction of the fund alone is enough to make it a complete non-starter as a means to participate in great small cap growth stocks. But the more you explore this small cap fund is actually, and what it's actually invested in, you find significant number of its top 10 holdings are definitely not small caps. So that definition I gave you in terms of small caps in Canada, that they are market caps of 800 million or less. Well, we see here, again, to be included in most small cap funds, you should have a market cap of less than 1 billion. There are some small exceptions due to performance gains, but on average, it should be in that range. Again, look at this fund. The top 10 holdings. Celestica has a market cap of 7.88 billion, which is nearly 10 times the upper limit of what is considered a small cap in Canada. The second largest holding, Ivanhoe Mines, has a market cap of 25.47 billion, nearly 31 times larger than what is considered a small cap in Canada. Number 3, ARC has a market cap of 13.56 billion. Fairfax, 38.42 billion. Again, I think you see where I'm going. You can see that on the screen here. In fact, not a single stock in the top 10 holdings of this small cap fund is actually, by the most generous definitions of a small cap stock. Now, I point out the fact that there are 0 points, as I point this out, 0 small caps in this small cap fund. I kind of feel like Jeff Goldblum in the first Jurassic Park, where he's touring Jurassic Park, and the first 3 exhibits show no dinosaurs, and he turns to the camera and he says, are there going to be any dinosaurs on your dinosaur tour? And I would say, are there going to be any small caps in your actual small cap fund? Not only are there no small caps in the top 10 holdings, nearly half of these companies would qualify as US large caps. They're not even the ballpark of what we'd consider a Canadian small cap. So the more you look at this fund, which is marketed to Canadian investors as a small cap fund, the more silly the entire exercise becomes. It helps big banks sell exposure to a segment of the market which is saleable because small caps historically outperform. But as you can see, if you want to actually participate where most 10x stocks are found, you should not buy this fund or other big bank funds that mirror it. Now, I've been researching and recommending Canadian small cap stocks for a quarter century. There are typically never more than 25, 20 stocks at any given time that we could buy. Most of the time, it is far less. Think 5 to 10 stocks in this segment that have high quality and trade at reasonable price. But somehow, all of these funds manage to hold and find and hold 100 plus great small caps to be invested in all at one time. It's a poorly thought out, poorly constructed from a return perspective. They're just engineered by the fund company to sell an idea. That idea, small caps, good, and make money off that idea. Not designed to pick great companies and try to outperform. If you want to mirror the small cap index, just buy a low cost small cap ETF like the iShares Russell 2000 ETF, for example. If you want to use small caps as part of the growth area of your portfolio, buy them individually and use good research. That would be my take. Take control of your portfolio. If you want to beat the market by incorporating great long-term capital compounding small cap stocks, you cannot be the market. You cannot own 116 or hundreds of these individual companies. You want to create your own simple equity portfolio. Build with a mix that looks more like this. As you can see here, 5 to 8 stocks. If you're having 25 stocks in the portfolio, 5 to 8 from core Canadian small cap stocks, in terms of if you're using our research, 5 to 8 from core Canadian dividend stocks, 5 to 8 from US growth or small caps, and 5 to 8 from US core dividend and dividend stocks. All right, that's my soapbox for today.
Yeah, I mean, it's quite eye-opening. Just, I remember when you initially uncovered that ETF, and we're just like, these poor people that are invested in it, thinking that they're in a small cap fund when it couldn't be farther from the truth. It's quite, eye-opening, I guess, to the average Joe,
Like, I knew this went on, but when you, again, pick a random fund, like I just picked, okay, we'll go to TD, one of the largest funds in Canada in this space. And then you look at the holdings, and I was surprised to see not a single in the top 10 would even, qualify as a small cap in Canada. And then like to hold like the Fairfaxes of the world, like your $38 billion, that is a US large cap fund that is in this small cap. it doesn't make a lot of sense to me. Like, I get they have a large amount of funds that they're trying to deploy, but if you cannot deploy them, then you have to, stop the fund. You can't hold that much within the fund. You can't have that much in terms of assets under management if that is the reason you can't deploy in small cap funds or stocks.
Yeah. And that was the first one that you...
Yeah, that's just the first one I came across. I didn't have to do a lot of research to find one that fit any narrative or anything like that. Yeah.
50 of the top small cap are thematic funds.
They are, a lot of them have huge issues, particularly, again, the big banks. But it is strange to call this.
This is also a good lesson as well, why at least some level of financial literacy is important, even if you are going to use a financial advisor, because you need to be able to check what your financial advisor or your asset managers are doing. You're paying them fees. You want to make sure that they're doing what they tell you that they're doing. And you can't know that unless you have some basic level of financial literacy.
No, agreed. And you could do a little bit of quick research. You could say, what is a small cap? And Google will bring that up for you. And you could say, okay, let's look at a couple of these companies. Like, again, all I did was look at the top 10 holdings. They're right on their website there. Couldn't find, obviously, all they have really is the top 10 holdings just displayed there. You can look and find all of them as well. But I mean, you can, the top 10 holdings and not a single one. I mean, most of them, the other thing is if they were on the edge of being a small cap stock, but I mean, most of them are not even close. Like when you're talking about market caps of, most of them 10 billion plus, and 25 billion with Ivanhoe, 20 billion Tourmaline, and 38 billion in Fairfax. They're not even masquerading on the edges of being a small cap stock. These are US large cap stocks by definition, most of them, and being in a small cap fund just seems really out of place. And again, if the reason was they bought them 10 years ago in this fund and they went up so much that they were, a huge part of the portfolio. But again, then you look at what percentage of the overall fund they now rank as. And you look at Fairfax, it's just 2.5. Well, I guess they could say we've been trimming. Once it went above 2.5 or 2, we trimmed it off. But again, the point is to gain great exposure to great capital compounding stocks. And if you just keep trimming the best winners, you're not going to gain the best exposure to those companies anyway. So anyway, I don't believe, again, that fund probably got too large and they're just, we can't invest in. It says they also invest in mid caps, but again, these aren't mid caps either, basically, in most cases, right? So. All right, we'll move on.
I've just been quickly Googling some of the other ones that are non-TD ones as well. And some of them are better, but for the most part, they will still have a couple of those stocks, which are 5-10 billion. And those are specifically the small cap ones, not the small mid caps. So you still have drift. But even further, if you want to look past just small cap ETFs or funds, some thematic funds that are just absolutely awful as well, is you need to look at the holdings. They advertise it as whatever theme, whether it's like AI or something, but then they have something else completely arbitrary in there and it might be 10% of their holdings. And I see that time and time again with these specialty funds.
Oh, yeah, they have a stock that, we have looked at extensively and they're included as whether it's a tech fund, and we don't consider that stock tech at all. It may have tech in their name, but often they're not what we consider that type of business. And you see that quite often. So you have to actually look at what you're holding if you really want to,
I agree with that.
Gain exposure to some of these themes.
I agree with that exactly. Just last point, just the amount of, people that I'll talk to and they'll say, I'm in this fund, and it's like, I'm just in this fund. I don't know what's in it. As an investor, you should just be you can quickly Google the fund and it'll show all of the holdings. So, you can know if you're in Apple, et cetera, any stock that's actually in that fund. So, I think that is always a good practice if, your advisor or whoever is, placing you in these mutual funds or ETFs, to understand exactly what is in that fund itself.
Yeah, and they should be able to have someone they trust, so they don't always have to do that and look at every single company. I mean, if you want to do it, for sure, but like in this case, if they're put in this fund by someone they trust, because it is their option in the small cap segment. I mean, again, we just went through it. The top 10 holdings are definitely not small caps. So a significant portion of this fund is not small caps. So strange and not a good way to gain exposure to that segment. All right. We had another question. Again, we're getting more and more questions. It's great to see as this channel, as we call it, I guess, on YouTube grows. But we, on Doman Building Materials, has a yield of around 7%. Aaron's going to look at that. We started off with the poll question talking about dividend stocks and yields, and I mean, there is some opportunities there. So I mean, again, this is an investor kind of playing on that theme, saying, here's a high yield, or what can I do in my portfolio as rates go lower? Is Doman a good solution?
So let's take a look at Doman here. First, we'll just look at the question. This is from Alice, one of our YouTube subscribers. Alice said, I'm looking at some higher yielding stocks that have potential to do well as interest rates fall. A company I came across is Doman Building Materials. It has a 7% yield. Do you think that the dividend is sustainable? So I'm looking at two things here. One is the dividend sustainable? Two, is this company well positioned as interest rates fall? Is this going to be one of the beneficiaries of a declining interest rate environment? So let's take a look at this company, Doman Building Materials. So what they are a vertically integrated distributor of building materials and home renovation products, servicing construction, renovation, and industrial markets. So traditionally, they've been known as a wholesale distributor of building materials like lumber, other types of materials as well. Interesting is that in addition to distribution, the company also owns and manages timberlands as well. As another segment of its business. So this is a vertically integrated supplier of building materials. The symbol is DBM on the Toronto Stock Exchange. It trades at a price of about $7.70, and it is yielding 7.3% right now. $673 million market capitalization as of today. So when we look at the 3-year chart on Doman, we can see, it's really kind of traded in a range, moved up and down over this period of time, but not really a recognizable consistent trend here. So primarily what investors have been receiving over this period of time is that dividend yield, that attractive income yield. So there's a few things that I'm going to look at here to answer Alice's question. One is I want to look at how the dividend compares to the earnings per share, cash flow per share from the recent financial performance, and just how the financial performance is trending. Then I want to see how the dividend compares, or if it's being covered by earnings and cash flow historically, how volatile the earnings and cash flow have been. And then I also want to take a look at the balance sheet. So these things are going to tell us, how sustainable the dividend is in the current situation that they're in. So we'll start off by looking at the recent financial results, Q2 2024. These were not very strong results at all. So sales down 3%, but adjusted EBITDA down 23%, and adjusted earnings per share down 41% to 20 cents. So big drop in adjusted EPS. Dividend payout ratio for the quarter was 70%. So that's up significantly over the same quarter last year, as we would expect, since earnings are lower, but still what I would consider to be reasonably healthy payout ratio, 70%. The company is covering its dividend with earnings, at least based on the last quarter. Now, if we look at how the company has performed historically, going back 4 years, and also as well over the trailing 12-month period, we can see trailing 12-month earnings per share, the blue column there on the far right, 73 cents compared to 56 cents in dividends. So still covering that dividend with some margin over the trailing 12-month period. And then going back historically, back to 2020, we can see some fairly significant volatility in financial performance here. The company's maintained a fairly stable dividend. And even though earnings have been volatile over this 4-year period, we can see in every year they are covering their dividend by what I would consider to be a fairly comfortable margin. So I don't see, I have some concern here just in terms with how the earnings and the financial performance are fluctuating. I'm also noting that the trend right now is lower earnings in 2022 compared to 2021. Then again, another drop in 2023. Trailing 12-month earnings still again lower. So there is a negative trend in earnings, but certainly in every year they've been able to cover their dividends. So I'm not necessarily seeing anything here concerning regarding the dividend sustainability. But I do want to look at the balance sheet. So that's something that's very important. If they have debt to service, if they need to refinance debt at a higher interest rate, given the current interest rate environment compared to a couple of years ago. So debt for the company is about $810 million. And if you look at EBITDA over the last trailing 12 months, this would be a net debt to EBITDA multiple of 4.5 times. So we would consider net debt to EBITDA to be a key leverage ratio for analyzing the balance sheet. 4.5 times, I would consider this multiple to be high. So I consider this to be a highly levered balance sheet. Typically I would want to see for a company like Doman, I'd probably want to see a net debt to EBITDA below 2.5 times, just given the company does have some cyclicality in its financial performance. Now, some companies, if you're in the utility space or REITs where you have more stability and visibility in terms of future cash flow, you can have a higher leverage ratio. But I wouldn't want to see for a more cyclical company like Doman a ratio this high. So I consider that highly leveraged, and this doesn't lend itself well to the long-term sustainability of the dividend, because if interest rates were to continue to increase, this is the type of company that could get into a lot of trouble. However, interest rates right now seem like they are not trending higher. It seems like they are trending lower. So this can actually be a good thing for a company like Doman building products. But just in summary, one thing we do like about the company is that in spite of it generating lower earnings in more recent periods and having fairly significant fluctuations in financial performance, this is a company that continues to generate solid earnings and cash flow year after year after year. So they're covering that dividend. They're maintaining a healthy payout ratio. I don't have any near-term concerns right now regarding the sustainability of the dividend. I don't see any major red flags. And the company is also very cheap from a valuation perspective. But there is the concern about financial performance trending down. And certainly the leverage being so high on the balance sheet would be something that would really cause us to kind of slow down and really look at that with caution. So the reason why I'm really not concerned about this right now is because we've seemed to turn the corner in terms of where interest rates are going. And now instead of going up, interest rates are going down. So higher rates were undoubtedly an issue for the company over the last couple of years. Even if you have fixed debt, you still have to eventually refinance that debt into something at a higher interest rate. And if you have variable rate debt, then you're incurring those higher interest rate costs essentially right away. So it has been a major net negative for a highly leveraged company like Doman to be in this environment of higher interest rates. And as well, higher interest rates have no doubt been impacting the company's end markets. So now as interest rates are going down, we would see this as being a net benefit to a company like Doman. That said, I don't like to invest based on, where I think interest rates are going to be in 1 to 2 years. There's just too many unknowns. I really want to look at the fundamentals of a business. So right now I'm seeing too much debt on the balance sheet. I would like to see that addressed. And I would also like to see some sign that the company is turning the corner and starting to produce earnings per share growth. But overall, the fundamentals aren't too bad in terms of the cash flow, just high financial risk.
I think it's a good summary. I think that like you said, interest rates are kind of a mixed bag for this company. They're coming down, which is likely a positive in terms of their debt. In terms of where in the future potentially their end market building market will be. But the reason they're coming down, one of the reasons, is a weaker general economy, and one of the things we've seen being impacted first are companies that we monitor that are in the construction sector, and you've seen kind of guidance be lower, a weaker second half. And so is that going to go on with Doman? Is that why we're seeing weaker results right now? I mean, one company that Brennan will talk about today, right, is in the building industry, and they're looking at weaker. They have headwinds in the near term. Another company we were monitoring just this morning that we may interview this week too, just had delays in projects and announced that, and the stock's down 20% today because essentially, you're seeing delays in building going in the near term, and so I would say with Doman. You've got that sitting in front of you, a weaker end market in the building segment in the near term, which is a negative. So, I mean, like Aaron said, maybe if you like the 7% dividend, it's probably decent right now. But even if you look back to 2008 on this company, the stock's basically in the same place it was then. So, not a lot of long-term growth in the share price. There is a solid dividend. That's probably what you're getting in the near term, I think, Aaron.
Yeah. I mean, I think that you really want to look at this as a higher risk, higher yielding income opportunity right now. And there's certainly upside. I mean, if interest rates continue to trend down, which most people seem to think is going to happen for at least the near term, then there's potential for share price appreciation. I would just say investing like that, there is an element of speculation as well if you don't like all of the other fundamentals of the company.
Yeah, like one thing that I'd also add too is like, I mean, I can understand because it was like, in the wake of the pandemic, like the company did, I mean, Aaron showed it up on the screen in his one slide that the company ended up reducing its quarterly dividend from 14 cents to 12
just temporarily
cents per share.
Yeah, for a couple
just temporarily. So, I mean, seeing just that earnings are coming down, could there potentially be a decrease? I mean, and again,
well, if they continue to come down, then I would say that there would be.
Yeah, exactly. And like, that's the thing. I'd like to look
if they
like
start
even
to go back
term.
up again, then probably not.
Because like if we look back like long term, 10 years, like just to see kind of like the volatility in that dividend, if there's any, maybe it's been consistently growing over the whole time. But
no, it's not been really a dividend growth story.
Okay, perfect.
Yeah. So no, I pulled up the history of it. It's been at 14 cents for over the last decade since 2012.
Yeah,
and they did actually end up paying back those extra 4 cents as a special dividend for the ones they did miss. Yeah.
I did see
that wasn't uncommon with the dividend payers during the pandemic. Quite a few of them, they would cut or reduce during 2 or 3 quarters, and then they ended up paying it back as a special because really at that time no one knew how deep a recession would go at that time. Yeah. So it was really just capital management more than anything.
Well, thank you, Brett, answering my question in real time.
All right, well, let's not shift gears too much, but we're going to look at another company in the building sector, another Your Stock Our Take, which came in on Atlas Engineered Products, AEP, on the TSX Venture, a company that we will be sitting down with the management team this week.
Mm-hmm. So I will take it away here. Atlas Engineered Products, AEP, on the TSX Venture, currently trading at a price of about $1.32 and about an $85 million market cap. So they design, manufacture, and sell engineered roof trusses, floor trusses, and wall panels, and distribute engineered wood products for use by builders of residential and commercial wood-framed buildings. And the company's strategy is focused on profitability and organic revenue growth within its current markets and the pursuit of a roll-up acquisition strategy to consolidate similar companies operating in the truss and engineered wood products industry across Canada. So I covered Atlas back in February of 2023 and again more recently in July of 2024. And the last time that I covered it, I indicated that the business was not cheap based on its trailing numbers, trading at 40 times trailing earnings and 15 times enterprise value to EBITDA. Given the market is anticipating the company's recent investments to propel the financials over the next 2 years. So quickly updating the business here. The company has made 8 acquisitions since going public in 2017, with the most recent acquisition in August of 2023 when it acquired Leon Chouinard, which is located in New Brunswick, which I did touch on briefly in July when I covered the stock last. And just last week, the company announced that it completed due diligence for a truss manufacturing company located in Western Canada and intends to close the transaction in early spring of 2025. And the purchase price is about $3.8 million in cash and stock, plus a working capital adjustment. And the acquisition target generated about 3-year average revenues of over $11 million, net income of about just under $1 million, and adjusted EBITDA was about $1.2 million. The CEO also mentioned on the conference call that they are seeing potential deal flow very, very strong at the moment. So, that is definitely something that we're going to be talking to Hattie about when we sit down with him in the next couple of days here. So I also kind of touched on these in July as well, but I'll briefly mention them. On June 26th of this year, Atlas closed a bought deal and concurrent brokered private placement for aggregate proceeds of $14.5 million through the issuance of about 10.8 million shares at a price of $1.35 per share. So the share count should now be closer to, I believe, about 69 million shares outstanding. And on June 6th, the company announced that it accepted proposals for the installation of robotic automation equipment at 3 of its locations, and that it has made initial deposits to secure the installation of equipment. And the robotics installation is expected to have a total cost of just over $7 million for all 3 of its locations. And the robotic automation is anticipated to double the board foot output of roof truss manufacturing while providing potentially significant cost savings. And I saw an estimate from a CoreMark report, which placed the estimated robotics initiative to cost between 25 to 26 million Canadian over the next 2 years, with a new greenfield facility accounting for about 15 to 17 million. And the investments are expected to increase truss manufacturing capacity by about 400% at High-Tech, 100% at LCF, which is the acquisition that I just briefly mentioned there before, which they made in August of 2023, and about 50% from Clinton, which is all in all expected to lower operating expenses and approximately a 50% reduction in labor costs. Again, we're going to be asking CEO about this just to get some more color here. And the robotics upgrades are expected to be completed over the next 2 years. Now, moving on to the recent financials for Q2 of 2024, it was a pretty decent quarter due to the acquisition, but revenue increased about 34% to $15.1 million, again, due to acquisition growth as well as some organic sales growth. Adjusted EBITDA was up 50% to $3.1 million due to an increase in revenue. And net income was down about 10% to $700,000 or about 1 cent per share, due primarily to the amortization related to the intangible assets of the LCF acquisition. The balance sheet looks quite healthy. They have about $20 million in cash with $29.9 million in debt and leases, providing a net debt position of just under $10 million. And the company has a trailing net debt to EBITDA multiple of about 1 times, which is reasonable. And just looking at the outlook, management indicates that markets continue to be very competitive in 2024, given rising interest rates, which have affected the housing market and the company's near-term growth. But the company notes that it recognizes the need to be ready for a potential significant increase in demand as interest rates decrease during 2024, given the number of homes still needed to be built to support Canada's population growth. But again, management did say, there's a lagging effect as interest rates come down and when this demand will come. So I thought it would be representative this time to show some rough pro forma numbers for fiscal year 2025. Keep in mind, these are very rough. But essentially, this is what is allowing the stock to hold up quite well despite headwinds across the sector, given elevated interest rates. So if we include fiscal year 2023 financials as a base, and add about 7 months from the LCF acquisition, which was closed August of 2023, as well as 8 months of the new acquisition, which we are hypothesizing will close in May of 2025. Again, we have no idea if it'll actually close in May of 2025. Could be later, could be earlier. Along with potential 50% labor savings from the robotics investments, we would be looking at revenue of approximately $71.7 million for 2025, adjusted EBITDA of about $20.9 million, and net income of about $12.8 million. Now, keep in mind, again, I am making assumptions here, which may or may not come to fruition, including, potential cost savings being realized in 2025, which may actually only come in fiscal year 2026. It does not include any unexpected acquisition costs or drag on earnings from investments, as well as assuming the acquisition will close in the spring of 2025, specifically in May, like I said. So again, please take these figures with a grain of salt. But if we use these figures to look forward, the company is trading at about 6.6 times forward earnings, and with an enterprise value to EBITDA multiple of about 4.5 times forward. So as you can see with my pro forma numbers, the stock is holding up quite well, given the assumption that forward numbers will look quite well, despite the headwinds that we're seeing across the sector. Plus, the shortage of Canadian homes appears to provide a good runway for growth for Atlas, or at least that's what management has been indicating. And whether I think, it's a buy, sell, or hold, I think it really comes down to whether an investor believes Atlas will be able to fulfill their new upcoming capacity, moving into 2026 and capitalize on the potential cost savings, which could grow earnings over the next few years. But again, we are seeing, elevated interest rates potentially disrupting the company's near-term growth. In fact, as I was mentioning that CoreMark report, they've actually reduced their outlook quite substantially. And even my revenue numbers are more modest than even what they're anticipating for fiscal year 2025. So as Ryan said, we will be speaking with management on Thursday this week to get some more insight on the potential cost savings, strategy, and ability to fulfill capacity, and for us to get more color on the current market environment given elevated interest rates. So if you have any questions that you would like me to ask management, feel free to comment them on YouTube as soon as possible to make sure that I see them before our actual interview, and I will try to make sure that we ask them.
Yeah, it's a good summary. I mean, certainly a company we are interested to talk to. I mean, if they can hit on those numbers, 18 months out from where we are now, then, 16 months, if it looks, it would look attractive at that point, but there's a lot of ifs
exactly
for them getting there.
I think that there's like what the company's betting on here, which maybe isn't an unreasonable bet, but they're betting on a big increase in demand, right? So
yeah,
I see huge production capacity increases at their facilities. But what do they need to do to get that 50% labor cost savings, right? I mean, I imagine they need to be operating somewhat near capacity or above a certain level.
Part of it is like automation too, right? A big part of it. Automation is a big part of it. Like robotics, they've installed automation.
Certainly, but if you build robotics that are capable of producing, like, say, 1,000 units a year, and you only have orders for 200 units per year, then you're, depending on how you're going to
I think you got to have both things combined, demand and using the new equipment.
So, and I think that it's reasonable to think that there's a good probability that, demand is going to increase, because they're right. We do have a housing shortage here. Rates are starting to come down, but they're making a major investment. And if it doesn't play out in the time frame that they're planning on, that's a risk. But I mean, in all things, there's a risk. It's interesting business. I like the idea of investing in efficiency.
Yeah. If you see a recession and a housing slump for a year and a half, they're not going to hit those numbers. So I mean, that's in all likelihood. But if you see a normalization and an increase in the housing market, like, they could hit or beat those numbers. So I mean, that you're overlaying a prediction on the economic or on the economy, generally speaking, into this company as risk. But most companies have some economic risk. This would be on the higher end of that. Building can be boom or bust relative to some other segments. All right, I think we've hit Atlas, and we'll be interested to see what they have to say in our meeting this week. Let's look at Simply Solvents Concentrates hash on the TSX Venture. And Brett's got that one for this week.
Yeah, so Simply Solventless Concentrates, HASH, or hash on the TSX Venture, develops and manufactures cannabis products, including pre-rolls, concentrate, distillate, amongst other products. The company developed the Astrolab and Fruity Hootie brands in-house and has acquired Lamplighter, Royalty, Zest, and Rylax brands over the past year. As well, they recently closed on their acquisition of CanMart, expanding production capabilities just this last month. The stock IPO'd on the TSX Venture in December 2023 and has since risen a whopping 155% to 51 cents a share, resulting in a $38 million market cap at this time. So strong performance post-IPO. Some IPOs, you'll see the complete opposite, where it quickly drops. Here's the opposite, where it quickly rises over the next year. But it's quite good, to say the least. The company has, however, changed significantly over the past year, and that's really been reflected in the share price. So we need to keep that in mind when looking at financial metrics, as you have one-time costs, capital structure changes, revenue and cost structure changes, just to name a few type of things, which can result in messy financials and really limit any comparability year over year. So a quick look at the Q2 financials with that in mind. The company had gross revenue of $4.2 million, net revenue, which is post the excise tax, or the cannabis tax really, of $2.9 million, a gross margin of 59%, adjusted EBITDA of $952,000, and an EPS of 2.4 cents. All these were significantly higher year over year and even quarter over quarter, largely due to the various acquisitions, so not really great comparison, which is why I'm not going to go through them. But the company did as well note organic growth. So overall, good performance, and it's roughly in line what they previously projected. At the end of Q2, the company had $110,000 of cash with $965,000 in debt and $1.3 million in leases, resulting in a net debt position of $2.1 million. So at the end of the quarter, the company really needed to raise cash. You see that only a bit over $100,000 in cash. They need to manage their working capital as well as get cash for the acquisition of CanMart. So doing so, in July they placed 15.4 million units, which consisted of share and a half warrant at 25 cents a piece, raising $3.85 million less the fees, which after the cost of CanMart put the company in the net debt position of roughly $0.6 million. But this will likely be different at the end of Q3 once you see the actual results, is to give a ballpark figure of all this movement, which is a really running thing in this company, as there's a lot of movement going on. But it's good to have a general idea of where they have on hand. But you're likely going to have different things that happen in Q3. So some things that have, as well, which will have happened, is exercise of shares, working capital changes, and so on, and then just general operationals, building or changing the cash position. The company, like I said, has been really building up that inventory in both raw materials and process, now at $12.4 million, to prepare for growth expectations. And this is to really do with all those additional acquisitions to build up additional revenue, but that also does cause them to take on additional risk, as if the company is unable to meet its sales expectations. When it has built up all this inventory, it has to sit on it for longer periods of time, which means they may need to raise more capital through share issuance, debt, and so on, just to cover that working capital. Because if they need to just pay labor costs, they need to pay their employees. That's one of the quickest ways companies can get in trouble, is they invest in a bunch of working capital. They need to still pay their employees, still need to pay their rent, and so on. And yet, if they're not selling the product at the rate they need to raise more capital. As well as we've seen this actually in the cannabis industry before. We saw significant impairments of inventory for both retail and just the raw material manufacturers, or growers, I should say, in, 2017, 2018. And then they had massive impairments, which caused a significant amount of following bankruptcies not soon after, or takeouts at dirt cheap prices. The share structure will likely significantly change if the share price remains the same, in roughly the same ballpark, as the company has significantly warrants and options outstanding. At the end of Q2, they had 53.8 million shares. The company then, after the quarter, issued 15.4 million shares. They had 26.5 million warrants exercisable at 20 cents a share, plus the further 7.7 million issued after the quarter at 40 cents a share, and another 1 million at 25 cents a share issued to CanMart as part of the acquisition, as well as 4.9 million of stock options exercisable at 19 cents. If they're all exercised, which at the current price they likely will be, it's the stock's trading at 50 cents or above at this time. And all these strike prices are in the 20s, or at the highest 40 cents. They're going to get exercised come once the holders really want to. Sometimes they'll run down the clock right until the maturity date, but other ones they'll just exercise earlier, depending on what the prerogative is. And if they all are exercised, there'll be 109.3 million shares outstanding. That's over a 100% share increase since the Q2 outstanding. And that's really the cost of all these acquisitions and inventory buildup and so on, which they've done over the last year. That's the combination of it. And they would receive over 4 million in cash due to the exercise as well, though. The company has been providing guidance for Q3 2024. The company expects gross revenue of 7 million. And considering the fact we're almost done Q3, that's likely going to occur. Adjusted EBITDA, of 1 million and normalized net income of 1 million, as well as projecting an exit run rate of 33 million in revenue, slightly below the previously projected 34 million the company had in its slides from July's. So slightly below, but not the end of the world. That ends up only being really 2%, 3% lower. Further, they reiterate their projected 2024 exit run rate of 40 million revenue, 6.2 million adjusted EBITDA, and 6 million in a annualized normalized net income. I will note run rates, especially exit run rates, do really have a risk embedded in the assumptions as they imply the continuation of financials at that end of the quarter versus trailing where everything's been done. So there's a bit of just more risk embedded in that, but it has the benefit of being forward looking, which is something you always want to do as an investor, is look forward. However, it is not really uncommon either when a company undergoes these significant operational restructurings like Simply Solventless Concentrates has, as trailing results are really just too distant from the existing operations. You don't want to just be saying, oh, we're going to measure you on what you had a year ago. You want to measure it now, but that does have that risk. Like I said, is you really only have a point in time versus a series of times. So using the projected run rates for Q3, the company trades an adjusted run rate PE of 10.6 times, but when fully diluted, that goes to 15.5 times. I will note the market cap, which I said before, already actually had some of those dilutions, specifically the share issuance in it. So that's why it's not exactly a 100% difference. If the company is able to grow and exit Q4 at its projected run rate, it puts diluted adjusted PE at 9.3 times, which becomes more appealing, but it needs to be executed on, which is where a lot of that risk is. So concluding, the company is not trading at a high valuation, but this is likely due to the current risk. The balance sheet isn't great. While the last raise helped tide things over, the company needs to start funding its operations from internal cash flows. The company does have that share dilution overhang, which at current prices will all be executed given the discrepancy between the strike price and the current share price. The company needs to execute its projections. The price of the stock implies significant weight on relying on those projections at this time. So if any material misstep happens, that could end up causing the stock price to plummet. So really, this is just a monitor and evaluate at this time, as it's not a screaming buy, it's not a massive discount or anything. If it does hit the projections, it will probably be a good value, but you are carrying quite a bit of risk. Because if things do turn sour, it will turn sour quick. And we've seen that a few times before, to say the least, when it comes to the cannabis sector.
Okay. I got to say, I don't often, one of the statistical or the projections that they had here was a pro forma projected annualized normalized net income per share. We may calculate those as analysts for companies, internally to try to value a company, particularly in the small cap sector. Often we're saying companies, can you give us a normalized figure, or give the market? We can do the normalized figure. We'd like them to do that, but we don't typically see companies going to that extent to do this. Again, pro forma projected annualized normalized net income per share. That is not seen often. I'll tell you, I've been looking at companies for 25 years, and I don't know if I've seen that once. But again, thanks for putting that together. It is a prediction going forward, and we have to, you have to, because there's not a huge track record of that company hitting on those. We have to. It's not that we're saying management is lying or anything like that. It has nothing to do with that. It's just it's a figure that we have to take and take with a grain of salt. Kind of, we have to see management be able to execute that over the long term.
Particularly given the industry as well, right?
Exactly.
Because we've heard so many promises and projections made by companies in this industry, and they've, in virtually every single instance, they've underperformed.
Yeah,
missed.
Yeah.
I mean, even like just look at like 2021. Like I recall like, several, like the amount of projections that were out there, or I think it was 2021 or 2022 with cannabis companies, the amount of projections that it was going to be such a frothy year. And then it was just cannabis company after cannabis company was just missing. And then like Brett went over, I'm glad that he did, just like the inventory, all of a sudden then we see like the amount of inventory write-downs that these companies were making because, the price of cannabis is just absolutely plummeting because all you like the barriers
it's
to
a commodity.
entry. Exactly. It's a commodity. I literally got a question from that or from a client the other day, asking like, hey, would you
in the
classify
entire
cannabis as
industry, at
commodity?
least here, was basically cultivation in people's basements. So, obviously it's not that difficult to grow it, produce it.
Yeah. Like,
well, I remember
competitive advantage.
I remember a particularly impassioned investor in the sector back when I spoke at the Toronto Money Show, right when it was being legalized. And I had said that we couldn't find a company to invest in that was profitable at that point. And he just was yelling, the demand will be there. The demand will be there. And I said, well, I know the supply is there because we've calculated it an oversupply, a significant oversupply. I hope the demand is there. And then you saw too many participants, oversupply, and it's a commodity and prices have come down. That's not saying that this simply solvents business cannot be successful. They have been profitable, it looks like, in the last couple of quarters, which is great to see. And we'll sit down with management. We'll ask some questions to the team over the course of this week. It'll be good to get their feedback on those, on some of the questions we have. And again, we can go on their current performance, which has been solid. It's the projection that I think the stock is starting to trade at, and the management team and everybody involved that's invested would like it to trade on the forward projections. Projections are they're projections and subject to risk, and whether this company can hit on those, particularly in terms of an EPS on the bottom line, not really a real EPS bottom line with the dilution that we're seeing, it remains to be seen at this point.
Yeah.
Yeah, and that's really what I was trying to get at by listing all this stuff off is there's a lot of moving parts, especially being a post-IPO company. So on top of the projections, which have dozens or hundreds of assumptions cooked into them, you also have just the structure of the company changing as well, which impacts the per share count, which is what really you should care as an investor. You don't really run off the raw net income, you're running off the per share net income. So if they just dilute you away to fund their acquisitions or their companies, not saying that they are, but that's what we've seen many, many times before. And it's something you need to be cautious about whenever you're seeing these massive capital structure changes.
100%.
For sure. That's a good summary. And I look forward to sitting down with management.
Me too. And for sure. Again, just it is a commodity. Cannabis is a commodity. If you guys looked in my living room, it looks like an absolute jungle in there. There's 60 cannabis plants that are growing right now. I'm joking. I only kid.
We're editing that out. That's all I can say. All right. Well, I think that's going to end our show for this week. Brennan's got to get on a plane. Well, that's tomorrow, I guess, and come out here. We'll do some interviews. It'll be excellent. And he'll look forward to seeing Aaron. Aaron won't look forward to seeing him probably, but we'll get together, and Brad will have to hold down the fort because we'll be on the road.
It'll be a nice vacation
downtown Vancouver. Yeah, it's true. You won't have to talk to us as much. It's good. All right. Well, again, if you're viewing this on YouTube, smash that subscribe button. Keep your questions coming in for our Your Stock, Our Take segments. We'll endeavor to answer those on a weekly basis. If you are just listening to this wherever you consume your podcasts, remember to rate and review us on there. And as always, I'd like to wish you profitable investing. Thank you.
Thank you.
Thanks, everyone.
Thank you.